Hey, folks, welcome to episode 9 of the Taylor Tax Show. I'm Terrence Taylor, and he's Big Al Darnell Jr. Say what's up, Big Al.
What's going on, everybody?
So, as you know, we put together this podcast as the co founders of Taylor Tax so we can help highly paid, highly taxed, high profile taxpayers like yourselves save a bunch on your taxes. We want to democratize the sophisticated tax strategies that folks who have a lot of money tend to use. So, for those of us who are coming up on money or making some money now, we could also use those tax strategies. And we want to level the paying field. So today's topic is what, Big Al? What are we talking about today?
We're talking about strategic giving in a tax-based world.
Strategic gift giving in a tax-based world. Okay, love
Yes,
it.
sir.
Say
Yes,
some
sir.
more about that.
All right, so cool. So here's the thing. When it comes to strategic giving, there's so many ways and strategies around it, but we're only going to focus on 3 of them. And those 3 are donor-advised funds,
Uh-huh.
personal family foundation, and then we're going to talk more about some of the lifetime gift exclusions and the annual gift limits and how some of those things could be structured so that you can make sure that you are doing great in the world, but also doing great from a tax standpoint in your
Love it.
personal lives. Yeah.
Love it, Big Al. All right, so let's jump in, Big Al. So donor advised funds. That's a mouthful. What is that all about?
Well, with donor advised funds, the beautiful thing about that is, is number one, you get to direct how the money is used. But I guess even bigger than that is that you could contribute up to 60% of your adjusted gross income to a donor advised fund. However, let's just say if you made $100,000, or we're talking about the highly paid, right? So let's just
Yeah,
say you make $500,000, all right,
yeah,
this year,
500K. Yeah.
500K. You could give up to 60% of that, which is $300,000. All right. Now, here's the thing, though. You get to advise where the funds go, but they don't have to go at the same year that you give it. So you get the immediate recognition of the $300,000 donation, but you can decide to give it over a multiple number of years because it's inside of this donor advised fund, which you no longer have control over exactly and immediately, but you get to decide and direct where it goes and when it goes to those charities in the future.
And Big Al, when you say recognition, are you implying that I can write off 300,000 from my, for example, 2024 tax return
Correct.
if I put 300,000 into a donor advised fund in 2024?
Yeah, 100%. Even if that money doesn't immediately go to a nonprofit in 2024, so long as you put it in that fund in 2024, you get the full write-off.
Wow, that's
Yeah.
amazing. So, for example, if I'm in the 30% tax bracket and in 2024 I give 300K to I put 300K into a donor advised funds to give to a charity or charities of my choice, I can get a tax deduction of
Yep.
300K, which can lead to me saving 180,000 on my taxes if I'm at a 30% tax bracket.
Yes, sir. Yes, sir.
Man, this is fantastic.
Brother, here's the thing.
Fantastic, Big
And we're
Al.
just thinking about money right now. Here's the thing.
Yeah.
Let's just say that I made $500,000,
Yeah.
but I own a house in Alabama, which I do. All right. And I know that, hey, because of this portfolio that I'm building, I'm trying to only invest in the West Coast or some other area. I wanted to, if I wanted to, I could donate that house to this donor advised fund. All right. I'd get the immediate write-off, but based on how that fund is being managed, that house can continue to be managed, it could grow in value, and then be distributed out over time to other people, or the profits that are made from it could be distributed out. But of course, that depends on what company is housing your donor advised funds. But yeah, you don't have to just contribute cash, but you could contribute cash, you could contribute appreciated stock, appreciated real estate, or any other asset. The whole key is that you get the immediate tax write-off because it is a donation and it is a contribution. It is a strategic giving,
Mm-hmm.
but it doesn't immediately have to be sold and go to a nonprofit at that point in time.
Big Al, the other thing I remember is when you first told me about donor advised funds was this notion also of avoiding, which is legal, capital gains taxes on appreciated stock.
Oh, 100%. But that's just not the donor advised funds. That's also in the personal family foundation.
Well,
All
let's
right.
talk about that. Let's
All
talk
right. So,
about that.
of course, no. I
Yeah.
get even more excited about the personal family foundation. Well, see, here's the give and take of it all. With donor
Yeah.
advised funds, you get to donate up to 60% of
Mm-hmm.
your adjusted gross income, but you're not in full control, but you do get to direct where it goes.
Mm-hmm.
All right. Now, when we switch over to a personal family foundation, you can only donate 30% of your adjusted gross income. However, you are in complete control because it is a private family foundation. It's run and operated by you and your family. All right. So now with a private family foundation, let's switch this up. I could
Yeah.
donate my property
Yep.
into the Alabama property into the private family foundation. I
Mm-hmm.
can hire my mama, which still
Mm-hmm.
works, which still lives in Alabama,
Mm-hmm.
to manage that property. I can
Mm-hmm.
pay her for managing the property and
Mm-hmm.
then make sure that 5% of the value of all the assets
Mm-hmm.
goes to a um, goes to a
Five.
nonprofit, a
Yeah.
501c3.
501c3.
And my
Yeah. Yeah.
mama could actually decide which nonprofit it goes to based on, what we've ratified in our constitutional documents for the foundation of how things should go. But the beautiful thing about that is that, like with a private family foundation, you're in complete control. All right.
Mm-hmm.
You're
Mm-hmm.
in complete control, except now, mind you, you don't get to personally benefit from it
Mm-hmm. Mm-hmm.
because it is a foundation that is meant to benefit the general public by donating to nonprofits. However, what you put in there can appreciate and grow tax free. So
Mm-hmm.
now, if this house, think about this. Let's say I bought the
Mm-hmm.
house for $100,000
Yep.
20 years ago, and now 20 years later, it's worth $500,000. All right.
Mm-hmm.
In Alabama, maybe not 500. Let's just say it's $300,000. All right. So now it's worth $300,000. I get the $300,000 write off. Let's just say it stays in there for another 20 years, and now it's worth $500,000. All right. So now, if it's sold in 20 years from now for $500,000, you could imagine that's either a $200,000 increase in value or a $400,000 increase in value for capital gain.
Mm-hmm.
In both situations, no taxes have to be paid on either of those capital gains.
Wow.
However, the funds stay inside of that foundation,
Mm-hmm.
and then once again, only 5% has to go out to a nonprofit. Not
Wow.
saying that, hey, guess what? Make sure that you pay somebody 95% of the fund and only donate 5%. No, the primary goal and purpose is to help out the general public or in the direction that of your choosing. However, the beautiful thing of this is, to me, when it comes to finances, control is the goal. And with
Yes.
control being the goal, what you're able to do is you're able to feed your family and feed the poor. You're
Mm-hmm.
able to benefit the community and to benefit, you know, uh, your family as well, your
Mm-hmm.
children.
Mm-hmm.
So in doing so, you can hire children, let that be their first job so that they can have experience. Let them
Mm-hmm.
do an internship there. Instead
Mm-hmm.
of instead of just giving your mama money to help out with their finances and so forth, you
Mm-hmm.
can employ your parents. You can employ a sibling and so forth
Mm-hmm.
and let them do the work of helping others out, which then
Mm-hmm.
helps them out, which then helps you out, which then
Mm-hmm.
helps
Everybody.
everybody out.
It's
It's
a
a beautiful
win,
thing.
win, 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 win. Right?
100%.
Yeah. And Big Al, when I first found out about personal family foundations, I actually thought like, where have I been? Like, why didn't I know this? Like, why
Yeah.
don't they teach this? because it's such a powerful tool to allow us to do good and get tax write-offs and save on our taxes. I mean, 30% of your adjusted gross income can be put in a personal family foundation each
Definitely.
year. So if we
Definitely.
use this $500,000 example, 500,000, 500K example again, that's 150,000 that you can put into a personal family foundation.
Yeah.
And if we use that 30% tax bracket again, which I suspect is probably not the right one, but just to make the math simple,
Uh-huh.
so 150,000, 30% of that, that's 45,000 that I'm saving on my taxes.
Definitely. Think about this, Terrence. And this is why I like this episode of
Yes.
strategic giving. All right. Strategic
Yes.
gift giving, strategic giving is
Yes.
because like the highest amount is this donor advised fund. But
Yes.
that doesn't mean that, guess what? I can only contribute to a donor advised fund.
Right.
Listen to me. I grew up in the church. All right.
Yeah.
And we got tithes and offerings. So
Mm-hmm.
10% needs to go to God. All right.
Mm-hmm.
So now I can give 10% to my church.
Mm-hmm.
I can give 30% up to 30% to a private family foundation. So that's just
Mm-hmm.
20% above the 10%.
Yes.
Then I can give 50%, up to 50% to just any nonprofit in general, up to 50% of my adjusted gross income. But with a donor advised fund, it's 60%.
Mm-hmm.
So now, overall, I'm not saying that you add all those percentages up and it's over 120%. I'm just saying that just from a, a easy example, if I made $1 million, that means I could give 100,000 to my church,
Mm-hmm.
200,000 to my private family foundation. All right.
300,000.
Well, I could give 300,000 to my
Yeah.
private family foundation.
Yeah.
But what I'm trying to say is I'm
Okay.
stacking them in a measure
50%.
to get to the 60%.
Got it. Got it.
100 grand to the church, 200
Mm-hmm.
grand to my private family foundation to get me to that 30%.
Mm-hmm.
Uh, I could give another $200,000 to another charity and another 100 grand to my donor advised funds. That way
Mm-hmm.
I've given 60% of my money away.
Mm-hmm.
But remember, the amount above 50% went in a donor advised funds, which keeps me within that cascading
Mm-hmm.
system.
Mm-hmm.
Now, I'm only suggesting and only mentioning this because we're talking about highly paid, highly taxed, high profile individuals. A lot of
Mm-hmm.
these cats don't need half of their money to live off of.
Mm-hmm.
Totally
Mm-hmm.
crazy enough, depends on how you're living or whatnot. But once you're
Mm-hmm.
making like $1 million a year, like really, yeah, once you're making $1 million a year, you should. No, let me not even say that. Let me not even say that. But it's easier once you pass that $500,000 threshold to live off less and less of your actual income. And the goal by doing this
Yeah, yeah.
is that you're going to be taxed a lot less, so you get to keep a lot more because you're giving, but you're in control of it.
Well, that's why I want to come in, Big Al, because oftentimes when we say highly paid, folks think like you got to be at 500,000 or 1 million. Of course, it helps to be there, but
Yeah.
even if you're not, right?
Mm-hmm.
We had a consultation the other day where there's a person that wanted to talk to us about potentially becoming a client, and turns out that they're making a little over 200K, right?
Yeah.
The reality is, if you get your tax affairs in order, and strategic giving is one of these levers to pull, you could keep more of your money because you're keeping control of your money. You're structuring what you're doing with your money in such a way that you're getting, in the case of a personal family foundation, and the example that we use, like if you're at 500K, you're getting 45,000 of taxes that you've paid back.
Yeah.
And if you're at 200K, right, then that math changes a bit. So it's 60,000, but now you're getting 60,000 that you can put in, but you're getting 18,000 back from
Yeah.
taxes you've paid.
Yeah.
So regardless of the income level, these strategies and this particular lever can be so helpful in how you save a bunch on your taxes and how you get more of the money. You keep more of the money that you make to use to do the things that you care about and to live the
Exactly.
life that you want to live, as opposed to just
100%.
paying it all in taxes.
Exactly. And it's not about living the life that the government tells you that you need to live and
Right.
giving to the places the government thinks you need to give it to. Oftentimes the
Yes.
government is folks, just like most of everybody, for some reason, the primary focus for most people is security. All right.
Yeah.
All right. I'm not sure if on Maslow's hierarchy of needs or the fundamental needs of a person, if security is number one. It's pretty sure it's number one, two, or three.
Safety and
But like
security.
when we're talking about a government, guess what their number one form of security is?
Mm,
It's a military. All
mm,
right. So,
mm,
and we've
mm,
already heard about the military industrial complex, so on and so forth.
mm,
But if you support that, go for it. Go ahead and give the majority of your money to the government. However, if you're looking at it from more of your particular household and your community's
mhm,
standpoint, I'm pretty sure, giving your vantage point, that there's a lot more that you can do for you, your
mhm,
family, and your community when you strategically give
mhm.
in your control and under your means. All right.
Yeah. Folks, as you can hear, Big Al and I are very passionate about this
Yeah.
topic, and I see we want to. I want to make sure that we also spend time talking about general gifts
Yeah.
and the exclusions that the IRS has for us each year, and briefly touch on what the lifetime um, gifting number is at this stage. So, Big Al, I'll set it up, and then we can just chop it up quickly, and then end this particular episode. So,
Cool.
folks, when it comes to giving gifts, one of the things that the IRS allows us to do is each year it gives us a specific amount that we can gift to individuals. And for the individual that receives the gift, that money in their hands is not taxed. So it's not that you're going to save by gifting or giving this money as a gift. The person who receives it is going to save because the IRS will allow them to receive that money tax free. And in 2024, that figure is 18,000 if you're filing single, right? Filing as a single taxpayer. Turns out that if you're married filing jointly, then you and your spouse or partner can give 18,000 each combined to individuals. So these can be family members, these can be friends, and I doubt they would ever give money to frenemies, Big Al, but even
Hmm.
frenemies you can
Yeah.
give this money to. And the beautiful thing then is instead of 18,000 per individual, it's 36,000 per individual. Anyway, I mean, this is just fantastic. Big Al,
One hundred
say a bit
percent.
more.
Well,
Mm,
I'll tell you this. There's this opens up the door for so many things. Now, the lifetime limit is right now is 13.61 million. All right.
mhm,
From a gift giving standpoint, where you don't have to
mm,
pay gift taxes, which are like 14 to 40%. All right.
mm. 18, I think, right? 18 to
Okay, yeah,
40%.
18 to 40%. Thank
Yeah,
you so
yeah.
much. So
Yeah,
think
you're good.
about like you're getting taxed 40% just to give money to people. All right.
Mhm,
But by understanding this, then
mhm.
this is a legal form of structuring that you can do. Now, when it comes to structuring with putting money into a bank account, you're not supposed to structure. That's illegal. All right.
Right, right.
Don't just put $9,500 in, $9,800 in, et cetera, et
Mhm,
cetera. That's structuring in an illegal sense.
mm,
In a legal sense, from a gift giving standpoint, if you and your spouse, married individuals, you all can gift $36,000 because 18 grand each to
mhm,
other individuals. Now,
mhm,
why in the world are we thinking about this from this standpoint? Is because when you're talking about the exclusion of $18,000, that
mhm,
means that this doesn't count against or count towards your lifetime limit.
mhm,
Now,
mhm,
when it comes to estate planning, which we're not on yet, but when it comes to strategic gift giving, we're
mhm,
not looking at a next year or the next 5 year or even the next 10-year approach. We're looking over your entire lifetime.
mhm.
So think about it. There is absolutely no limit on the number of people you can give these gifts to,
No limit.
but there is a limit on how much you could give. But think about it like this, and we'll talk about this. We just had our last podcast was about insurance. Our
Yes,
next podcast is going to be about retirement, and the
yes,
following one is going to be about estate planning. And we could
yes.
talk about this more in estate planning. But
Mhm,
as I mentioned on our last podcast, we met with Terrence about insurance. All right.
mhm,
Now we're going to build this situation up with our trust where we are funding insurance policies for our children and for our children's children and for their children, et cetera, et cetera. Now, this is where a lot of this strategic gift giving comes into play, is that I can now gift a insurance policy of $36,000 per year to each of my grandchildren, and it doesn't count towards my annual gift giving limitation. So now, if I've got 10 grandchildren and I want to fund an insurance policy for them and front load it for these children, I could donate $36,000 times 10.
Yes, you and your wife can. Yes.
My wife and I can. All right.
Yes.
So now that's 360 grand that I'm able to reduce my overall estate by, because we're looking at estate taxes as well for when you pass away. So we're not just talking about gift taxes right now, or we are talking about gift taxes, but this helps out from an estate planning perspective, because if I get to reduce my estate by 360 grand each year, then it gets me closer to being under that limit as I continue to grow over time. Look, there's so many ways that you could tweak this thing, and it's only going to benefit those next generations, because when you're front loading an insurance policy that they can grow tax free and pull from tax free, then we're talking about generation after generation after generation earning wealth upon wealth upon wealth that you can continue to cascade around the whole tax burden situation. But anyways, we're already over time, man.
Big Al, I'm shaking my head because I'm so excited. I want to keep going on this topic, and I know that we're trying to keep the podcast to a certain amount of time so folks can listen and enjoy the entire podcast. Folks, this is a topic that we'll come back to. We promise you.
Definitely.
As we do our work as Tailored Tax, and as we work with our clients to help them to save a bunch on their taxes, these are the levers that we're pulling on. And Big Al is already starting to give you a preview of how we think about this holistically. All right. So, folks, thank you so much for listening to the Tailored Tax Show. We will see you soon.
Cheers.